So we're going to finish working on the problem for calculating financial ratios, problem SE11 on page 229 in our financial accounting textbook by Needles and Powers. So we calculated the other day from the data given to us in the problem the actual income statement. We calculated a multi-step income statement in order to get our bottom line net income number of $30,000. Now we can start proceeding forward with the rest of our financial calculations. We actually do this calculation because we will need this information in several different places, and I want you to be able to be familiar with how to get this net income number from the set of data that's given in a problem or similar problems. So let's proceed forward. We're going to start out by first calculating our profit margin or net profit margin ratio. And for all of our ratios, the first thing we will do is put in the components of the ratio so that we can make sure we're accurately representing how the ratio is calculated, and I can ensure that you know what you're doing with regard to these types of problems. So our first ratio, our profit margin, is our net income divided by our sales. And that information is both pieces of that information are here in this calculation here, where we've got our net income and we've got our of 30,000 and our net sales of 260,000. So we'll put that up here. 30,000 divided by 260,000. Which gives us a profit margin of 0.1153, which we will round to 11.54%. Okay. This space here would allow you to do that same calculation to get your net income. But again, I prefer you to break it out as indicated below so that I know that you are practicing how to complete a multi-step income statement and it becomes more familiar to you. Okay, our second ratio is going to be our asset turnover. And the ratio is calculated by taking net sales divided by average total assets. And we already know our net sales number, 260,000. However, we have to calculate our average total sales figure. And they give you the data in the textbook. It's going to be to calculate the average total assets. It's going to be the ending balance from the previous year, or the beginning balance, which is the beginning balance for this year of the total assets. So that's 200,000 plus the ending asset value for the current year, and that is 240,000. And then divide that by 2, and we get 220,000. It's our average total assets. So we're going to take that number, and that becomes the denominator for this problem here. And our 260,000 divided by our 220,000 gives us 1.1 times. So for every dollar of assets, we're generating 1.1 times that in sales. The higher that number, the better. Okay. Then our next ratio is our cash flow yield. And our cash flow yield is going to be our cash from operations. And normally this number would be in our cash flow statement. But the problem will obviously give us that data. And the denominator in this situation is going to be our net income. And our cash from operations number was $30,000. And our net income, as we calculated previously, is $30,000. So this gives us a 1.1, a 1-to-1 ratio. And then our debt to equity ratio is going to be our total liabilities divided by total liabilities divided by our total stockholders' equity. And again, this data was given to us in the problem. However, if we were to be looking at this in a real situation, we would be getting this data from our balance sheet. So our total liabilities were $60,000, and our total stockholders' equity was $180,000, which gives us 0.33 ratio, which in this case, we're going to put this as times. 0.33x is going to be how we're going to represent this ratio. Okay. And this number, we prefer to have this number be less than 1 if possible. That means there are less liabilities relative to the level of equity in the company. But again, I think I mentioned this when we spoke about it in class, that it depends largely on the industry that you're operating in, as some industries are more leveraged, have more debt relative to their stockholders' equity than do other companies or industries. So you'll look at that as any of the ratios, comparison to each other, comparison to previous years, as well as comparison to other companies. Okay. Then we're going to look at our return on assets, and this is going to be our net income divided by average total assets. And we calculated that average total assets already up here, and we already calculated our income, our net income. So we're going to use that $30,000 of net income divided by our 220,000 of average total assets, and that is 0.1364, and we're going to convert this to percentages for 13.64%. And again, we would like this to be higher rather than lower. So in this particular one, we're trying to, demonstrate for every dollar of assets, how much profit are we generating? And so, you want that to be higher. What is the return that you're getting for every dollar of assets in your company? Okay, now we've got our cash return on assets. This is the cash from ops. Again, this would be in the cash flow statement in a regular company that you would be analyzing. And then in this particular one, we're going to divide that by average total assets. And our cash from ops is in our problem $30,000. And again, I'll use that average stockholders' equity is 220,000. So this is very unusual that the actual numbers are the exact same for your income and your cash from operations. That doesn't really happen very often. So our ratio is going to be the same number as above here, which is very unusual. Okay. Then we have our return on equity, which is our net income divided by our average stockholders' equity. And again, just like with the average total assets, we're going to have to do a little calculation here. If we were to be doing this in a regular real company using their data, we would be looking on the balance sheet and we would be taking last year's ending stockholders' equity number and the ending number for this year. But we're going to use the data from the problem, and that indicates that our number for the previous year was 140,000. And for this current year, it's 180,000. We're going to again divide by 2. And get an average stockholders' equity of 160,000. And we're going to use that in our equation. 30,000 net income divided by the average stockholders' equity of 160. And that will give us a return on equity of 0.875 or 18.75%. And again, you want this number to be higher. And this is basically a pretty important number from an investor standpoint. It's otherwise referred to as ROE, return on equity. And if I'm an investor, it's saying for every dollar of investment that I'm making, how much income is the company generating? So, obviously the higher the better, the more profit that they're getting relative to the amount that I'm investing. I want it to be higher or stronger. Okay. All right. Well, that just walks you through how to calculate all those basic financial ratios for a company. Hopefully that helps. And if you have any questions, please feel free to email me. please look in Google Classroom for your posting for your homework assignment. Thank you.